Welcome. This mini lecture is going to be dealing with receivables, bad debt, and interest revenue, and we're going to be covering this first page of notes, which is Learning Outcome 8-1 and part of Learning Outcome 8-2. Okay, the first consideration is the trade-offs of extending credit. If you remember, in Chapter 7 we talked about management issues related to inventory, and we're going to start out this chapter treating management issues relating to the decision to extend credit to your customers. So the first thing we need to consider are what are the upsides or pros, and definitely you can increase your revenue if you offer credit to your customers. On the other hand, let's consider the cons. We've got the increased wage costs because you'll need employees who track how much each customer owes and then follow up to collect the receivable, and also you're going to have someone that determines whether the customer is creditworthy as well. And despite how hard you try, some folks just won't pay you. They will not be able to pay. And so you're going to have some bad debts. This is a legitimate business expense. Your customer received the service or the goods, and you will unfortunately not be able to collect. And then thirdly, there will be a delayed receipt of your cash. Your customer won't be paying you, so you might have to wait 30 to 60 days in order to collect a customer's account in full. And of course, you need money to be able to pay your bills. We're also going to be talking about notes receivable, but that's going to be in a later lecture, so let's hold that until then. Now, Learning Outcome 8-2. Estimate and report the effects of those uncollectible accounts or bad debts. Well, you know that accounts receivable arises from the sale of goods or services on credit. When a customer pays you immediately, you increase or debit your cash account. But if your customer doesn't pay you and you've delivered a good or service, you need to debit something because you'll be crediting service revenue or sales revenue. What you would debit instead of cash is accounts receivable. It's a current asset on the balance sheet because you expect to collect that cash within a year or less. Now, there are two objectives when accounting for accounts receivable and bad debts. First of all, you want to report accounts receivable in the amount the company really expects to collect. That's called the net realizable value, but it's also called the net accounts receivable. And the reason why this is so important is that a dishonest business person could leave old bad debts that they know they won't collect on their balance sheet in order to mislead others into thinking that they will be able to collect that money. Perhaps creditors who are thinking about giving them a loan. And then unfortunately the creditor or potentially the investor could be hurt from that situation. So we want receivables shown at what we really expect to collect. The second objective or goal is to match the cost of the bad debt against the sale in the accounting period that the sale occurred. That's the expense recognition principle, matching the expense against the sale in the period that the sale occurred. Now, the difficulty is that bad debts will likely be discovered in an accounting period following the sale. You may not know when your debt is going to go bad. It may, in fact, if you knew a sale was going to go bad and you wouldn't have made that sale in the first place. So it's not going to take place closely to the sale. Most likely it's going to be 60, 90, 120 days later, or maybe even a year later, that you finally decide to give up on the collection of that account. So if that's the case, how will you match the expense of the bad debt or cost of the bad debt against the sale in the period that it occurs? Well, the answer is in using an estimate. So what we're going to be learning is the method required by generally accepted accounting principles. GAAP. It's the allowance method, and it's basically a two-step process. The first step is to record the estimated bad debts in the period the credit sale occurred. That satisfies that objective here, objective 2. And then when a specific customer's debt goes bad, then we write off or take off the books that customer's balance. And so let's take a look at the entry that represents the first step of that process. Adjust for estimated bad debts. So this is an adjusting entry, similar to the other adjusting entries you learned in Chapter 4. We're going to debit bad debt expense for the amount we estimate will not be collected from that period's sales or receivables. We're going to learn two methods how to do that in just another moment. We'll be putting that actually on the second lecture. We won't be crediting accounts receivable directly. First of all, we don't know whose debt won't be paid. And secondly, maybe we'll be wrong about the amount. So temporarily, we're going to credit the allowance for doubtful accounts. This is a contra account, a contra asset account, similar to accumulated depreciation that we learned about in Chapter 4. This account will be subtracted from accounts receivable on the balance sheet, and the result will give us the net accounts receivable, or net realized value. The net realizable value. That's the amount we think we really will collect. So this is an adjusting entry. When do we make it? Well, we make adjusting entries before we produce financial statements. Otherwise, the financial statements will be incorrect. So each time you produce a set of financial statements, you must do this adjusting entry. Now, when a specific customer's debt goes bad, comma, we know we won't be able to collect it, comma, we would do the write-off entry. And now that we know whose debt is not going to be paid to us, we'll debit the allowance account and credit that customer's specific accounts receivable. That's when a specific customer's debt is identified as uncollectible. Now, why would that happen? There may be an inability to locate the customer, or perhaps there was a bankruptcy involved. But whatever the case is, we've decided we can no longer collect on this account, and we would do this write-off entry. So these are the two new entries associated with accounts receivable. Now, there's one other thing. Up to this point, we have not really talked about keeping track of who exactly owes us money and how much. Now, of course, we do that in the real world. It's just that we tried to keep things a little simpler in our introductory financial accounting class. But in truth, we use what's called a subsidiary ledger. The subsidiary ledger of accounts receivable has the detail of each customer, how much they owe us, when they purchased it, if they paid it. We've got all that detail in the accounts receivable subsidiary ledger. And if you add up all the customer balances, it should equal the accounts receivable controlling account in the general ledger. So we keep one account in the general ledger called accounts receivable, and that's called our controlling account. It's the total of all the money that's owed to us. However, specifics on who owes us and how much that is kept in a separate ledger called a subsidiary ledger. Now that ends our first mini lecture for Chapter 8. We're going to pick up with ways of estimating bad debt expense in our next mini lecture.